Hey guys, Jason here from Positive Real Estate, and welcome to the Friday email, a bit of tips and strategies of property investing and how to keep motivated and keep going in the property world. Hey listen, today I'm going to talk about a few things, not necessarily about the strategies of the specific properties, how to buy a property at a discount or a renovation or a strata or something like that. One of the things as a property investor we must always consider, especially in the early stages of property investing, is when we go to buy a property, what structure or what type of entity are we going to own the property in or buy the property in? And what do I mean by that? There's three ways you can own a property, specifically in property investing. One, you can own the property in your own name, okay, which is useful for some reasons. Two, you can own it in a company or a trust structure or a combination of a number of different types of trusts and company structures. Or you can own it in a super fund, okay? Three ways. Now when you choose those three ways, you will have a different outcome financially now and later, which is very, very important as a property investor to consider, all right? And so those are the things that I want to cover today. Before I jump into that, I want to just talk about three phases of a property investor's life, okay? Over the years, I've coached hundreds and hundreds of people in their property investing, and they've been, from 18 years old to 80 years old, and obviously people at different ages will require different strategies and different buying entities and structures to be a property investor and get the maximum outcome short-term and long-term. There's not one size that fits all. It's very specified for you as an individual and what you do, whether you're a PAYG earner, whether you're a business owner, whether you're a self-funded retiree, whatever it might be, you will choose different ways to buy properties for a specific outcome. All right? And I'll show you what I mean by that in a second. So the three phases of a property investor's life over time are pretty simple to understand. There's the acquisition phase, right? And that might be a time frame of 0 to 30 years. It might even be longer, 0 to 40 years, who knows? Okay, there's acquisition. This is where you go and start buying property. You're buying property to obviously create wealth. And as you go ahead and do that in the early days, quite often you're looking for the highest loan-to-value ratio possible. You're trying to get your money to go a bit further. If you can borrow at 90%, you might go ahead and do that, all right? And so you're trying to get your loan-to-value ratio up. Quite often in that stage, when we buy properties, especially if we're looking for good capital growth property, often that comes with some sort of negative cash flow, okay? And we might have to top that negative cash flow up with some structures about buffers. We might have to use our tax deductions. We might even tip a bit of our income in to make sure it all works as we go along as a property investor. How we structure that really well at the beginning makes sure that we're able to continue to move forward from a cash flow point of view and a servicing point of view. So in acquisition, there's some certain things that we've got to go ahead and attempt to achieve. Using our tax deductions is really important at that stage, and we talk about negative gearing, okay? Now you can get a tax deduction by having, as well as having a positive cash flow property. A lot of people think that positive cash flow, you don't get any tax deductions. That's not correct. And so in the beginning, in acquisition, we've got to make sure we combine these things very, very well. In the next phase, which I call consolidation phase, where sometimes people might choose to sell some of their properties. And so these are some of the things we say: buy 10 properties in acquisition, sell 5 and keep 5 in consolidation phase. The point of consolidation phase is to reduce your loan-to-value ratio and increase your cash flow to make it positive cash flow in consolidation phase. So we may have bought 10 properties over 10 years, we sell 5, now we own 5 outright, our cash flow goes up and we own those properties with little or no loans against them. That'll be a fantastic outcome. Let's say in 10 years' time, 10 properties to 5 we own outright, okay? And then lifestyle, obviously, depending on your own outcome that you want to achieve, a lifestyle outcome. And some people call it a legacy outcome as well, maybe a lifestyle or a legacy, okay? You want to go and live it up big and have a party or whatever it might be, or you might want to leave some money or some of your assets and income and value to a charity, to something special, whatever it might be. And those are some specifics that obviously you'll choose to do at some point in time. But if we want to get to this place in a good, comfortable way, in a clever way, we must choose to buy these properties, or any investment really, but properties I'm talking about today, in a clever way, because we want to be able to try and minimise some of the things, the in and out costs of buying real estate. And what are those in and out costs of buying real estate that really erode our profits? And every clever investor knows if you manage them well, you'll end up with a better result. What are they? They're taxes. Income tax. As a property investor, we pay income tax. We can use property to minimise our income tax. That's one. Land tax. Can we minimise land tax? The answer is yes. Capital gains tax. Can we minimise capital gains tax? The answer is yes. Now, how do you go ahead and do that is how you buy these properties. And I was talking about before how you structure them, okay? Which entity you buy them in. The three entities, what are they? Who remembers that? Your personal name. You can buy them in a company, trust structure, or you can buy them in a super fund. Let's make a little Superman thing there. Super fund. So if you buy a property in your personal name, what are the advantages of that? Personal name, the advantage is the best one that is around right now is very easy to get a personal tax deduction. If you're a PAYG earner, you can get your tax deduction. And many investors that I know have reduced their tax down, and some have even reduced it to zero legally through a tax deduction process called a PAYG variation, a 221D. Any decent accountant who understands property can do this sort of stuff for you. Make sure you go and see your specific accountant to make sure you get it right. When you buy a property, you get a tax deduction and you can offset your income tax. Now that's fantastic. Well done. So then, in your personal name, that's fabulous. It's much easier to borrow money in your personal name. It's very easy to lend from the banks. One of the downsides of owning property in your personal name is asset protection. What happens if you have an issue and someone wants to try and take your assets, your personal name? It's very open to attack. So these are the things we've got to balance up as property investors. Easy to get the tax deductions, easy to get the loans, some other risks. And you've got to weigh them up, go and speak to a good financial planner or a good accountant to find out what specifically is going to work for you. A company tax structure, okay? Now, company tax structures, there's some benefits of those. They give some asset protection. They give some abilities to offset profits and losses. They give, depending on what type of structure you use, you can do some income tax adjustments as well. However, the problem with those company tax structures are that they're expensive to run. They cost you 2 or 3 or 4 times the amount, thousands of dollars each year. If you've got 2 or 3 or 4 or 5 of them, they're going to cost you tens of thousands of dollars each year to maintain and audit and keep your house in order. Okay, and so that's the downside. If you're only going to buy 5 or 6 properties, then a company trust structure may be prohibitive just because of the costs. They're difficult to borrow money, especially right now. Okay, so some people that I know as property investors have been limited in buying property because their properties are in company trust structures. Very difficult to get hold of. Okay, but there's some benefits there by offsetting capital gains tax and profits and losses and those sorts of things. But that's something you have to speak to an accountant about. Again, your super fund, and this is something that's really hot topic right now. The super fund is fantastic. Depending on your age and depending on what you're trying to achieve, how many properties you want to buy, you can buy property in your super fund. Did you know over the age of 60, you can pay 0 capital gains tax in your super fund? Even before the age of 60, the capital gains tax is significantly reduced as well, down to 10%. So as a property investor, that's fantastic. We love that sort of stuff. We want to minimise our costs. We want to maximise our profits. So you might buy some in your personal name, you might buy some in your super fund, and you might try and combine a really good outcome, a clever outcome as a property investor. And that minimises your taxes and maximise your profits as a property investor. And the way to structure that, obviously, will be specific to each individual as you go along. And so you must go and see someone who's got the right nous and the right passion about property investing too, like you. So anyway, everyone, that's about it for me this week. If you want to find out more about this sort of stuff, you need to come along and visit one of our property information nights. They're all around the country, and our guys and girls there who our coaches talk about this sort of stuff. Our accountants are down the back of the room. And this month we're running at our mentoring program a special on how to buy property in your super fund. We've got a very clever guest, one of our guest coaches who's a specialist in super fund buying properties. And that'll be fantastic too. So come along to our property information night, find out a little bit more, and hopefully you know, that's gets you going, gets you excited, and you end up with a far better outcome as a property investor than people who don't consider these sorts of things right in the first stage of property investing, which is the acquisition stage. Until then, guys, take care at the marketplace, and bye for now.